Hi everyone, this is Samit from TalksonGround. How are you? So today we are going to discuss about India's galloping economy and how it is doing and what could be the little tweaks India can do to make it even better. As you all know, India is the fastest growing big economy in the world right now. Even in the first quarter of this year, financial year, which is April to June this year, 2025, India grew at a very fast pace of 7.8%. And the expected result for July to September is also close to 7%. And if you look at the growth in the last 3, 4 years, it's been pretty good after that COVID shock, which took away a lot of economic heft for a lot of people. But is it hiding something that we ought to give some attention to? So that is exactly what we're going to discuss today. So I'm going to share a quick article which I think was very interesting and which I think we will kind of delve in more. So this is Zerodha, basically a broker. They have this brief, daily brief, and they give these articles. So I came across this, and I think it's a very interesting piece of work. So they're talking about, is there a private capex article? Sorry, private capex problem for India. So before we go into details, we should understand that I'm expecting a lot of you don't know what are the components of GDP and so on. Uh, Maybe all of you know, but there is one way of looking at it, which is to add up the consumption and the investment and net exports, and that gives you the GDP. And investment is really very important for a growth uh, story to happen, and that is where India has a problem. And this is what they're talking about. So, in the uh, investment from 2013, they're saying that private investment as a percentage of GDP has continuously declined. So, it is pretty close to 20% here, but you have to add up the public sector and private sector, it comes up to something like 30%. And if you see the India investment story, you can see it another way. This is adding up the public and private sector investment, and you can see it's closer to 30%, 31, 32%. Now, you must see in the same graph, you can see around 2008 when India was doing very well, it was almost close to 42%. Now, before we go any further, let's delve a little bit on what this means and how China has grown. So China grew its economy on the basis of having a trade surplus with other countries, as in they exported a lot of goods to the other countries and they imported less. And then they also were able to drive a lot of investment into infrastructure and so on, and also uh, developing new factories and new services and so on. So that is what has helped China. Now, India had a very high investment rate around 2008. Then the crisis of Lehman Brothers came around, and that's when India sputtered from an investment perspective. It's only in the last 3 years that the investment cycle has improved. Even now, it is just 32%. In, I think, 5 years back, it was down to 27, 28%. When you have that kind of a investment number, you're not going to get a lot of growth. And that is why India was starting to taper down. And that's when the government came up with the corporate uh, tax changes and so on. Now, let's look at some other data before we delve into other factors. Um, let's look at capacity utilization. So, what this means is if I have a factory and I can manufacture 100 units, and if I'm manufacturing only 75, then I don't need to set up a new factory for the same product because I can still deliver to the market based on this capacity. Of course, there can be technology changes, there can be other markets outside India that you find. So you need a new factory. So therefore, there are only uh, X number of ways in which you'll put a new factory up. Either your domestic market is growing, or you find a new market elsewhere, or there is a new product line that you have. So these are the only ways in which you're going to have a new factory coming up. Now, if I look at the components of this investment, there are multiple components of the investment that a country has. It has the households doing savings, it has the governments doing savings, and therefore investing, and also the private sector. Now, the government has been increasing the capex, or the capital allocation every year. But what about private sector? Anyways, let's look at the components. So if we look at this, you can see that the government has been doing a lot of capex, and then the private corporates, of course, are supposed to lead, but households have a big chunk of this, almost a third. And unless you get a property boom, and which drives up a lot of cement demand, a lot of steel demand, demand for all kinds of construction material, you're still not going to see that private corporate investment coming through. So we can go further. If I look at the government capex, it's almost 5% of GDP, which is not bad. I don't think government can do too much more. Uh, if we look at, um, okay, I'm going to open a PDF file which really is a study. Okay, so it is a ICRA study, and they are saying that India's GFCF, which is the other way of looking at investment, which is the gross fixed capital formation, is about 30% of nominal GDP. Um, in 2000, from 2015 to 24, it has grown at about 10%. In 2025, which is last year, it is supposed to have grown about 7%, which is not great. 40% of GFCF is attributed to the household sector. So you can see that this property purchases by households is what is driving a lot of this investment. The private sector, comprising all corporates listed and unlisted, account for about 30%, 35% of this. So therefore, the share of private capex overall has gone down to almost 33%, and PSUs have been investing about 5 lakh crores every year. Um, Corporate balance sheets have kind of cleaned up. There are better cash flows, and so on and so forth. So there's no real reason for people to not invest. Okay, uh, but that is what is happening. So I thought, let me think about what is stopping the Indian corporates from uh, investing. What are the various things that they want. Now, even without going into too much of details, let's look at what is it that a person will consider if they had to invest. So here you go. So we have already talked about capacity utilization. So the other end of this bargain is that you have consumption growth, for which the government has already done a GST cut. Then there is a environment of enforcement. Now, however, I hate saying this, but the fact that the government has gone after corruption has had an effect on the private corporate investment, because a lot of them uh, don't report all their income. Now, how do they end up investing all that unreported income into a greenfield project? So that's a problem. Uh, there is a domestic and external risk environment which has been there, including tariffs and so on. There's been a lack of policy continuity and predictability, even though government has fixed a lot of that in the last few, days and rather few years. There's been a lot of continuity. So I think some of this is getting fixed. Uh, there is actually more. So there is a operating margin that you need. So supposing you are not making enough profit, and whatever profit you make, then you pay dividends, you do share buybacks and so on. So that is not going to leave you too much of cash at hand to kind of make new investments. Then there is the uh, factor of cost of capital and its availability. So is capital available? So in India, a lot of big firms were not investing because they were not able to raise money from Indian banks in India, and they were relying on issuing bonds outside India and so on. RBI has made some changes recently, so that should ease some of the situation. So people keep talking about animal spirits, and I think the animal spirits can only come back once the environment is conducive for investment. Now, having discussed all this, let's go back to basics. So India's GDP, let's at different US dollar rates, as compared to INR, the exchange rate, whether it's 88, 85, or 80 or 90, whatever, the total GDP will be varying. Now, so let's take $4 trillion as the base benchmark. So at 32%, 33%, India's investment has is a corpus of about $1 trillion every year. Now, if you need to raise this 31, 32% to say 36, 37%, even if you can't raise it back to 40, you're talking about 5% of GDP. So 5% of GDP on 4 trillion is about $200 billion. At current exchange rates, this will come out to something around 18 to 20 lakh crore rupees. Okay. Government's whole budget is about 40, 45 lakh crores. So we are talking about a very large sum. So this can't be done in 1 year. So this will have to be a transition over, say, a period of 3 years. So you go from 31, 32 to 33, then to 35, then to 37. So each year you have to now raise 2% of GDP as the additional investment that has to come from Indian private sector, as in the list. And I will put my neck out and say it has to be from the listed companies mostly. Yes, some companies are very large and unlisted, but then we all know about them. So these companies will have to invest about 2% of GDP, which is $80 billion, which will be around, if I get my maths right, around 7 lakh crore rupees. Just to give you an idea of what this amount is, Google has announced a $15 billion investment in Andhra Pradesh for a artificial intelligence center or a data center. Now imagine this has to be basically multiplied by a factor of 7 to get this $80 billion every year, and you have to do it year on year additionally. So the task is really cut out for India. And if I look at the comparison between a China or a India or a US, you can clearly see India is a equity driven economy. So you really need a very deeper bond market, and the government has taken some steps. And if India does a rate cut, instead of relying on FDI too much, you can have Indian corporates raising a lot of cheap debt within India and launching some greenfield projects. And some of them will have to just augment, current products and services, just additional supplies, and some of them will have to be in new areas like AI and renewables and EVs and solars and rare earths and so on. So I think it'll be very interesting to see if India can make that transition, because if India can get, say, 3 years down the line, 2028 September, if you're talking, and India's investment to GDP ratio is around 37%, 36%, or anything more than 35%, I would say, then India would have already crossed that, uh, that threshold to sustain its growth rate for a long time to come. I thought, there are a lot of different views about growth, and there's a lot of different paths to the same thing. But this is one of the key things when you look at India's macroeconomy, that India's investment is low. And even though there are hundreds of projects that are announced pretty much every day, but when you aggregate it from a GDP perspective, they're falling short from as I said, the investment to GDP ratio. So that's what India needs to do. I thought I will touch upon this topic. We've done a lot of geopolitics and defense stuff recently, and I thought this will be a nice segue given the headlines that tariffs are making, the GST cuts are making, and India's growth story is making. So what do you think? I want to know what you think. What is your analysis? Do you agree with my analysis? Do you think India's private capex story is the one to focus on, or is it more about domestic reforms, which IMF has alluded to? Is it about land reforms and labor reforms and so on? Honestly, if you ask me, India can get there even without doing those reforms, as I've just laid out. You just get the top corporates to do some heavy lifting, maybe with some stake sales here and there, and you'll get there. And all you need to do is, do this for the next 3 years, $80 billion additionally every year from the Indian big private corporate sector, and you're home. So this was Summit from Talks on Ground. Hope you enjoyed this. I would like to, read your comments. Please like this video if you liked it, and share and subscribe, and share it with your families and friends. And hope to see you soon. Bye bye.